Good morning, it's Jeffrey Christian from CPM Group. It's 10 o'clock on Tuesday, the 26th of July. We are going to be giving you a briefing on our outlook for the PGM markets. We are releasing our annual Platinum Group Metals Yearbook this morning, about 200 plus pages on platinum, palladium, rhodium primarily, a couple pages on iridium, ruthenium, and osmium. We'll be going through a lot of these things. I'm joined today with Rohit Savant, who is our lead author of this report and he's the director and vice president for precious metals research here, and Carlos Sanchez, who is actually the director of commodities and asset management, but having started off at CPM Group in 1999 in research and continues to do a variety of research and has co-authored portions of this. We will be having a question and answer period at the end of this. You can ask questions on the question area in GoToWebinar. There's a little place where you can click and expand that area and then type in your questions. We'll deal with the questions as we can at the end of all of this, and we'll see where we go. I'm going to start by talking a little bit about the state of the economy and PGM markets overall and prices, and then I will kick the presentation over to Rohit, who will talk about platinum, palladium, rhodium, supply, demand, and market trends. Then I'll talk very briefly, I hope, on iridium and ruthenium and osmium, and then we'll open it up for questions. So let's jump into it. I have to start by thanking our sponsors and our Chinese partners. Without the sponsors, this research, our research is extremely expensive to gather data in extremely secretive markets. You can tell by the quality of other information that's out there. These are very secretive markets, and there's a tremendous amount of uncertainty and guesswork that other people have on supply and demand. There's a lot of guesswork in our work, but having researched these markets since the late 1970s, we have fine-tuned our ability to estimate supply and demand. And I think our track record sort of speaks for itself. But we have a number of sponsors from around the world. Europa Bullion, a bullion dealer in Europe, but we also have Monex, Noah Capital, which is an institutional investor in South Africa, Grid Metals and Group 10, who are exploration and pre-development companies with PGM properties, Kitco Metals, Umicore, one of the world's largest refiners and fabricators of PGM products, as well as products made out of other metals. The Institute of Scrap Recycling Industries, which represents hundreds of precious metal scrap recyclers in the United States. Sabin Metal Group, which is another one of the world's largest refiners of PGMs and suppliers of fabricated PGM products in the world. In China, our platinum and gold reports are translated and distributed by the China Gold Association, China National Gold Corp, and Beijing Yicheng Technology Company, which is trying to use technology to distribute information and other services related to precious metals in China. We also have an array of media partners and distributors, companies that help distribute our reports or distribute information about our reports, promote these kinds of briefings and other things. I won't run through the list of names there, but we're very happy and proud. And we're very happy and proud of the fact that they represent a wide swath of the international precious metals markets and business media. It's not a narrow group of entities. I want to talk a little bit about the state of the economy. Rohit will deal greatly with the state of the PGM markets, and I'll touch on it very briefly when I go through our price reviews. But the economy is very clearly important. And in the first 4 months of this year, you had the financial markets, not just PGMs, not just precious metals, but you had financial markets focus on inflation, high inflation, which led to concerns about higher interest rates, which led to concerns about real growth. And as interest rates started rising, you started seeing currency markets move, with the dollar strengthening against most major currencies because of the differentials both in the interest rates earnable in dollars versus other currencies, but also the economic prospects of the United States relative to those other countries and regions that produce major liquid markets. And of course, you had the war. Russia's invasion of Ukraine at the end of February have had a major effect. So in the first 4 months, you had a lot of these concerns, and it went from concerns about high inflation to concerns about interest rates to concerns about recession. And we're still at a place of great uncertainty. You'll hear people talking in the gold market, gold promoters, talking about how the Fed has to pivot on interest rates. And I'll get back to that in a second. But really what we've seen in terms of a pivot has been financial market attitudes over the last couple months away from some of those concerns to a more nuanced or balanced or uncertain expectation. We're seeing interest rates rise. We're seeing the Fed and the Bank of Canada and the ECB and the Bank of England all raise interest rates much more forcefully than the markets had expected even 4 or 5 months ago. We're seeing some signs of inflation peaking. Prices aren't coming down, but they're not rising necessarily as rapidly as they had been. Headline inflation in the United States is still 9.1, but if you look at the core inflation, it's actually fallen slightly over the last 2 or 3 months. Interest rates are rising. They're rising more forcefully than people think. I had thought they would, but there's also been a realization that while they're rising from very low levels. There are people in the gold market who look at, like to compare the current situation in 1979, 1980, but it's radically different. You know, we had inflation above 5%, between 5 and 14% for about 12 years before the Fed started raising interest rates. Interest rates, meanwhile, had gotten higher, and they were rising from, say, 3 or 4 or 5% up to 21%. Now we're coming out of a decade in which interest rates were basically zero, and they've risen to about 1.5%, and they probably will rise to something over 2% today when the Federal Open Market Committee issues its report. But they haven't risen to the levels that we had prior to, say, 2008, 2011, and they haven't risen to such high levels as we saw in the late 1970s. So there's still a tremendous scope for the monetary authorities, not just the Fed, but monetary authorities around the world, to raise interest rates to quell inflationary pressures without throwing us into a deeper recession. Now, we still have inflationary problems. And as CPM Group has talked about repeatedly, the Fed raising interest rates and sucking money out of circulation, and other monetary authorities doing similar things, can quell the inflationary pressures on the demand side of the economy. But what we've seen over the last 15, 16 months, which is the period, the duration of recent high inflation, and by high inflation, I mean more than 2%. Not 12 years, 16 months. More than 2%, up to 9%. A lot of the inflationary pressures have not been on the demand side of the economy. Some of them have, but on the supply side. And the effects of rising interest rates on the supply side is that they can contribute to inflation. because manufacturers and processors and wholesalers and shippers all pay higher interest rates, and they try to pass that cost of the higher interest rates on to their customers down the chain. So the Fed has limited effects on some of the inflationary pressures that we've been feeling. The other place where inflation pressures have come from are fiscal stimuli. And again, the Fed has no control over that. They go up to the Congress twice a year for the Humphrey Hawkins talks, and they say, you guys have to get your fiscal house in order. They have been doing that since the early 1980s, and the fiscal house has gone from a $58 billion deficit to a $3 trillion deficit. And from less than $1 trillion in federal debt in 1980 to something on the order of $31 or $32 trillion in federal debt. So there's only so much that monetary authorities can do. The big question now is, are we going to be in a recession? And the Fed's comment, the Fed's notice today is important. The other one is coming, I guess, on Thursday when we see the first flash estimate of second quarter GDP. We had about a 1.6% contraction in US real GDP in the first quarter of this year. And right now, market estimates are anywhere from negative 1.6% again in the second quarter to about 0.8% positive in the second quarter. So we are in a position where we may have a flash estimate later this week that suggests that the United States has been in a recession in the first half of this year. A shallow recession, which could be a short recession. These are CPM Group's projections. You can see here, if you go back to 1991 and then again 2001, short, shallow recessions. We may be in the midst of something like that now. You can also see from our projections that we're looking for, as we have been for several years, a deeper recession, 2024, 2026 timeframe. We think that both are possible. You could have a short, shallow recession now, and you could have a bigger one later. And that's the economic environment that flavors investor attitudes toward PGMs and industrial demand for PGMs. So that's what you're going to be looking at, not today, but for months and quarters to come. That's the world that is the PGM industries and investors are facing. So let me talk a little bit about PGM prices and also some inventory figures. These are platinum prices, and you can see, going back to 2011, 2012, they peaked around 1,800 to 1,900. They actually, on an intraday basis, had gotten up to about over $2,000 in the first quarter of 2008. But we only started this chart in 2011. You can see they started to come down after September of 2011. There were a number of economic issues that happened in September, including the downgrading of US debt for the first time in history, which was something that a lot of people in the financial markets had feared. And when it happened, it was pretty much a non-event. So there was a massive sell-off of commodities at that time. Gold, silver, Platinum Group Metals. And you start to see investors selling some of the platinum that they had bought, in many cases, between $500 and $700, $800 an ounce in the period 2000 to 2007. And some of that started being sold. And it was sold through 2012 and 2013 into the first half of 2014. Now, in the first half of 2014, the South African platinum mining industry took a major strike. They were at war with a very militant labor union. And we had a 6-month strike, during which time the platinum price did not rise. Anglo Platinum's CEO at the time kept coming into the market with public announcements saying, we have plenty of platinum and Palladium and Rhodium in inventories. No one has to race out and buy this stuff. We can supply our customers for an extended period of time, and we have so much metal that we can actually supply our competitors customers as well. And in that environment, those institutional investors and high net worth individuals who had bought a lot of platinum and palladium at $500 to $700 a decade earlier said, what happens when they settle? So they started selling. The price moved sideways. When they settled, the price broke below $1,400 in a forceful way, and it moved to $1,200 by the end of 2014, and then it moved to $800 by the end of 2015. And it basically traded between $800 and $1,000 for most of the period of time from late 2015 until the middle of, well, actually the beginning of 2021. We have been writing for several years that we thought that there would be an upward shift in the platinum price in a long-term basis, and that over the course of the present decade, you would see platinum prices break out of that 800 to 1,000 range and move into a higher range, and then higher range after that on a longer-term basis. And we started to see that in the first half of 2021. The pandemic was coming under control, vaccines were rolling out, the lockdown was ending, economic recovery was coming. And in China and the United States, you didn't have just economic recovery, you had very strong growth in demand for goods and services, including vehicles. And then you had those supply chain interruptions and supply problems and fiscal stimuli. So you saw the price of platinum shoot up very sharply in the first half of 2021. Other commodities were doing the same thing as the world came back to economic life following the recession of 2020 and the economic lockdown. That lasted pretty much for the first half of the year, and then the platinum price came back down. It was trading either side of 1,000, rose back up in early 2022, and now it's back down into the low end of that $800 to $1,000 range. Platinum prices last year averaged $1,090. That was up 22% from the 2020 average, and it was the highest average since 2014. In the first half of this year, platinum prices have averaged about $987 an ounce, which is down 16% from the first half of last year. But the first half of last year was this period where you saw the price actually rise over $1,200 for an extended period of time. First half of this year was a period where you saw the price try to rise above $1,200 but failed. There is a lot of platinum out in the world. CPM Group estimates about 14 million ounces, and CPM Group estimates that about 6 or 7 million ounces that is held by investors. That's important. You have the government of Russia that owns several million ounces, and it has signaled repeatedly, and there's every sign that it is happy to hold that as a strategic reserve, even before it proved itself able to become the pariah state of the world. You have estimated inventories that are held by the industry, and they've actually risen some. Then you have reported inventories, ETF holdings and exchange holdings, which are relatively small. And then you have those unreported estimated inventories of held by investors and other unknown entities. When we first started making these data, you can see from this line, we've been making these estimates since the late 1970s, and the cumulative surplus has been rising. And you can see there was a big increase from 88 to 94, part of which was increased South African production. Part of it was post-Soviet increase in production. You had sales of inventories from the Russian government into private Western hands and Asian hands at that same time. Then you had a kind of a pause from 1997 onward for several years. And then you had another round of stock inventory accumulation, really from around 2002 to 2007. I mentioned earlier, we saw a lot of institutional investors and high net worth individuals buying platinum at that time. And we saw it because a lot of them were our clients. We issued a buy recommendation on platinum, I believe in 2001, might have been 2002. And we said this metal has been treading water from a price perspective for a long period of time, but we think the price is going to rise. And we saw several million ounces of platinum bought by institutional investors and high net worth individuals in that time frame. They started to sell it off in 2012 and 13 and 14, but when the price fell below $1,400, they stopped selling. And they've actually been increasing their holdings over the last few years. When we started making this data public around 2013, 2014, at the request of some of the entities in the platinum mining industry, people looked at these numbers and said, this is ridiculously large. It can't be that high. Now I think it's probably pretty well accepted that inventories are about this high. Inventories at rest have no effect on price. If investors think that the price is going to fall, as they did in late 2011 through 2014, they will sell inventories and the price will fall. If they think the price is going to rise, they will not sell those inventories, and they might actually add to the inventories. And if other people aren't selling from inventories, the price will rise. But inventories at rest have no effect on the price, which is something important to understand. Palladium prices mirror image of platinum prices. Palladium averaged $2,392 last year. That was up 9.8% from 2020, but the price in 2020 was $2,178. You already had record high palladium prices. Palladium prices, which you can see here, traded below $850 for most of the period from 2011 to 2018, 17, and traded between 80 and 180 for much of the period from the late 1970s until the early '80s. Palladium prices have been rising very sharply for about 5 years, and they continue to rise. They have shown some weakness. The average was up 9% last year, but it was already very high. The high last year was $2,981 on a settlement basis, but on an intraday basis, the high was $3,019. In the first half of this year, palladium averaged $2,310. That was down 11% from the first half of 2011. On a daily basis, palladium settled at $2,981, the same as it had, that was a high settlement price in 2021. It was the high settlement price so far this year on March 4th, after the Russians had invaded Ukraine and before it was clear to the market that neither the Russians nor Western powers would do anything to interrupt palladium supplies from Russia to the United States and the rest of the world for use in autos and other industrial chemicals. But we hit the same intraday settlement price, but the intraday high, the same daily settlement price, but the intraday high, that was the settlement price was on March 4th. On March 7th, the intraday high got up to $3,426 on 7 March. So very strong price. You can see the spike here, and it's come down. And today it is trading around $2,000 an ounce. As with platinum, you have very large amounts of unreported inventories that clearly were built up in the period 2000 to 2007. And those things are sitting there at rest. We haven't really seen, as we did in 2012, 13, 14 in platinum, haven't really seen heavy liquidation of these palladium inventories by investors. These are long-term investors. There are people I met in the early 80s who had invested in palladium in the 70s who still own that palladium, or their heirs own that palladium and have added to their palladium position. These are long-term investors, not speculators. And they're very happy to have that metal. So there's a lot of palladium out there, but it is sterile to the price right now. Should that price start to fall in a longer term basis, it could mobilize some of that palladium, and that could be more detrimental to the price. But we haven't seen that yet, and we're not sure that we will. And then finally, rhodium. Rhodium prices went parabolic. They got up to almost $30,000 last year. They averaged $20,650 last year. That wasn't double the $11,600 or $11,220 average price in 2020, but it came close. In the first half of this year, rhodium prices have come down, and rhodium prices were averaging around $17,166 in the first half of this year. The markets remain relatively tight. The prices have been constrained by interruptions in auto industry production and sales. And when those interruptions in the demand side of the PGM markets change, then you're probably going to see higher metal prices again. I've wasted a lot of your time. I'm going to pass the screen and microphone over to Rohit and let him take you through the details of supply and demand. I'll come back at the end for minor PGMs and for Q&A. Thank you.
Thank you, Jeff. So I'll start here by talking about platinum. Total platinum supply, which is made up of mine supply and scrap supply, rose during 2021. While both mine supply and scrap supply rose during the year, neither rose sufficiently to fully offset the the losses that we saw in 2020. Total platinum supply last year stood at 6.85 million ounces, which was up roughly 7% from 2020 levels. But this was still lower than the roughly 7.3 million ounces in total supply that we were seeing prior to the 2020 year. One of the main reasons for the weak recovery in 2021 was that mine production was weaker in most mining regions, with the exception of South Africa. Output was down in Russia due to the flooding at two of Nornickel's mines. Labor strikes at Vale's Sudbury operation hurt Canadian platinum output during 2021. And then you also had declines at the Mimosa and Zimplats mines in Zimbabwe, which further weighed on platinum output from Zimbabwe. Also, while South African mine production rose during 2021 by about 12.5%, it still was lower than levels seen in 2019. And there's been a combination of factors, right from outright declines at some of the operations, long-term issues that have stifled both operations as well as investments in South African mining, an increased focus on UG2 and Platreef ore bodies, which have lower platinum content. These are all factors that have come together and have been weighing on South African platinum mining. Platinum scrap supply rose during 2021, driven higher by the average higher platinum price during the year and the reopening and somewhat smoother functioning of platinum scrap supply chains compared to what we had in 2020. One factor that did act as a headwind to scrap supply during 2021 was the shortage of freshly scrapped vehicles due to a shortage of new vehicle inventory. Total platinum supply this year we expect will weaken further. We have slightly slower or rather lower output from South Africa, which we think will offset gains in other mining regions. And scrap supply is expected to suffer due to further reduction in scrap vehicles, which is one of the main components of platinum scrap supply. So in recent years, there's been an increased focus on mining the UG2 and Platreef ore bodies in South Africa. The chart that you see on the top left-hand side helps to explain part of this. As can be seen in that chart, the UG2 PGM basket price has shot up sharply due to the higher palladium and rhodium content in this ore compared to the platinum-rich Marinsky ore body. The other factor which we can see in the chart on the right-hand side is that much of the Marinsky ore has been mined out and makes up a much smaller portion of total platinum or rather total South African PGM reserves. So a combination of both these factors has kind of shifted South African mining companies' focus towards the UG2 ore body away from Marinsky, and so this is something that's expected to act as a bit of a headwind to platinum mine supply going forward. So what you're looking at here is South African platinum mining capex. The South African capex rose during 2021 because of the long-term decline that we've been observing in the South African rand versus the US dollar. In rand terms, the capex was at a record high. In dollar terms, however, it was at the highest level since 2012. So while we did see a increase in the capex during 2021, there's some points worth noting about that increase. The first is much of that increase was the result of pent-up spending from 2020. And also a lot of the capex, when you break it down, was basically diverted towards stay-in-business expenditure versus project expenditure. And we think that this is something that would be a long-term positive for platinum because of the negative impact that it would have on long-term platinum mine supply. So last year you saw PGM mining cash costs rise to a record high level on an average basis. It stood at PGM cash costs on a global basis stood at $887 an ounce. Input cost inflation was the primary factor that drove costs higher. You had supply chain disruptions for inputs like explosives and chemicals, which was combined with higher fuel prices. There was a relative softening in the US dollar last year compared to 2020. And in 2021, there were still fewer PGM ounces compared to levels that we saw prior to 2020, which means there were fewer ounces over which to spread these costs. So all of these factors collectively, again, were responsible for a uptick in PGM cash costs during 2021. So with that, let's move on to platinum fabrication demand. Platinum fabrication demand rose at a healthy pace in 2021, but the growth was from extremely depressed levels. Platinum fabrication demand stood at 6.62 million ounces in 2021, which was roughly 8% higher than levels seen in 2020. As was the case in platinum supply, platinum fabrication demand also remained lower than levels that we saw in 2019 and prior to that. Platinum fabrication demand from commercial vehicle market, which is the most important for platinum fabrication demand, was a mixed bag during 2021, with demand recovering in the US and Europe, but falling in China and Japan. Another factor was the shrinking of market share of diesel passenger vehicles, which was another headwind to platinum fabrication demand last year. Platinum jewelry demand rose in 2021 with improving economic conditions, reduced COVID-related restrictions, which permitted more socializing and therefore also helped with boosting demand for platinum jewelry. Now, while platinum demand grew from both the auto and jewelry sector during 2021, that demand growth was fairly lackluster. but demand did grow at a healthy pace from some of Platinum's smaller users like from the petrochemical refining sector or the glass equipment manufacturing sector. And this did help to offset to some extent the relative weakness in growth in the auto and jewelry sectors. This year, we expect platinum fabrication demand to decline. We think that slowing economic growth, persistent vehicle inventory issues, high inflation, and rising interest rates are all factors that would dent platinum fabrication demand in the coming year. We forecast platinum fabrication demand to stand at 6.36 million ounces, down roughly 4% from last year's levels. So the next few slides review some trends in the auto market. As can be seen here, commercial vehicle demand slipped in China and Japan, but rose in other major markets during 2021. The weakness that we saw in China's commercial vehicle market followed extremely healthy growth during 2020. And despite the weakness that we saw in 2021, at the end of the year, commercial vehicle sales were still higher than those seen in 2019 or any time before that. So while demand was mixed in 2021, commercial vehicle demand has been weak across the board in major markets during the first half of this year. And this is in line with our expectations of softer demand for platinum in the current year. So another factor that's been hurting platinum demand, one of the factors has been the shrinking market share of diesel passenger vehicles in both Europe as well as India, where market share now at the end of 2021 was back down to levels that we saw in the 1990s. And so this is something that we think will continue in coming years and will also act as a headwind to platinum fabrication demand. So this chart shows the composition of passenger vehicle market share in Europe. And as can be seen, diesel has continued to lose market share into the first quarter of this year. Gasoline's market share seems to have stabilized for now, with lost market share for both diesel and gasoline going towards alternate propulsion technologies. It's important to note that not all alternate auto propulsion technologies are bad for PGMs. It's only the BEVs or the battery electric vehicles that are negative for PGM demand because they do not use any PGMs. All other technologies, whether it be hybrids or fuel cell electric vehicles, in some capacity or the other, they do continue to use PGMs, and so they're not as negative as the BEVs. So the chart on the left-hand side here shows global sales of battery electric vehicles and plug-in hybrid electric vehicles. And as can be seen, there was a sharp rise over the past 2 years, with much of the demand coming from China, Europe, and the US. And we expect these trends to continue in the coming years. The chart on the right-hand side shows global market share of battery electric vehicles and plug-in hybrid electric vehicles. And as can be seen, the BEV market share is more than double that of hybrids, which is primarily because there are more generous fiscal incentives for battery electric vehicles versus hybrids. So while BEVs are leading the race among alternative auto propulsion technologies at this time, it's still a very nascent industry, and the future could possibly see another technology taking the lead. In addition to hybrids, the fuel cell electric vehicle is another alternate technology that makes use of PGMs. And while this market is really small at the moment, last year you had something like 16,000 vehicles being sold. There could potentially be strong demand for this vehicle in the future, which could be supportive of platinum fabrication demand. Though right now there are a lot of hurdles that this industry is faced with, whether it's the production, transportation, or storage of hydrogen, the cost of these vehicles, the choices for consumers of these vehicles. So there's still a lot of ground to be covered, and battery electric vehicles still do seem like they're leading the race, but things could change in the next several years. So what you're looking at here is the platinum to palladium price ratio, which remains at historically low levels. And this has clearly been something that has benefited platinum, with increased interest for platinum, both from investors as well as fabricators. Fabricators in the auto industry, for example, have started to reintroduce platinum in gasoline auto catalysts, which is one of the most positive fabrication demand fundamentals for platinum in the medium to long term. So this is the platinum market surplus deficit. The platinum market remained in a surplus during 2021, but the surplus shrank some from 2020 levels. At the start of 2021, investors were willing to absorb that surplus and even outbid each other to access the metal. The availability of COVID vaccines and a reopening of economies had created a very positive sentiment towards all industrial metals, including platinum. That investor optimism began to slide as it started to become clear that the auto industry was not picking up quite as much as was expected, primarily driven by that shortage of semiconductors. The reduced investor interest in this metal surplus that we were seeing in 2021 began to weigh on platinum prices as the year progressed, and that's when we started to see platinum prices come back down from the highs that were seen earlier in the year. The platinum market is expected to remain in a surplus this year as well. Investors remain cautiously optimistic about platinum's future. And so while we don't really expect investors to try to outbid each other to gain access to this surplus metal, there is an expectation that investors will step in and buy. The more medium and longer term investors will step in and buy when prices come down, which should help to provide downside support to platinum prices in the coming year. So platinum ETF investors were net sellers of metal during 2021. That said, they had added large volumes of metal during 2019 and 2020, as a result of which, despite the decline in 2021, holdings at the end of the year were still higher than any time prior to January 2020. These investors have continued to be net sellers during the first half of 2022, reversing nearly half the combined net additions of 1.3 million ounces that they made during 2019 and 2020. Platinum coin demand has been on a rising trajectory over the past several years and rose to its highest level since the late 90s during 2021. These investors are typically longer-term value investors, and the historically low price that we've been seeing in platinum has been driving these investors towards these products. And we expect this demand to continue to remain strong in coming years. So with that, let's move on to palladium. Total palladium supply declined slightly during 2021, driven lower by weakness in mostly mine supply. Total palladium supply stood at about 8.9 million ounces, which was off around 0.3% from 2020 levels. The various mine supply disruptions during 2021, whether they were the flooding at Norilsk's two Russian mines, or the Vale's Sudbury operation being suspended, or Stillwater, US mines being suspended, all of that had a much larger negative impact on palladium mine supply than on the mine supply of the other PGMs. Palladium scrap supply rose pretty strongly during 2021, but those gains were not sufficient to offset the losses that you saw in palladium mine supply. Total palladium supply this year is forecast to decline. We do anticipate an increase in palladium mine supply, but we expect that that gain would be offset by declines in scrap supply. The issue of reduced scrapped vehicles is clearly going to be a problem for the amount of metal that can be recovered from auto catalysts this year. Fabrication demand rose during 2021, but still stood well below levels that you saw in 2019. The weakness that you saw during 2021 can almost completely be attributed to weakness in demand from the auto sector. The primary problem there was the drop in auto production due to the shortage of chips. The problem was further compounded by an ongoing growth in market share of battery electric vehicles. There were a few things that were supportive of palladium fabrication demand during 2021. One was an increased market share of large vehicles in the US and a preference for hybrid vehicles in Europe versus battery electric vehicles. So demand for palladium from other sectors held up fairly well during 2021. However, the large percentage of palladium demand from the auto sector makes it pretty difficult for other sectors to offset weakness in the auto demand. Palladium fabrication demand is forecast to suffer more in the current year. You have a number of headwinds for palladium fabrication demand this year. First being, vehicle production is still hurting from that chip shortage. You have ongoing increases in battery electric vehicle market share. You have slowing economic growth, high inflation, high interest rates, high gasoline prices, which could push consumers towards smaller cars and battery electric vehicles. And there's also an increase in the use of platinum in gasoline catalysts, which are all factors we think that would are coming together and are expected to hurt palladium fabrication demand during 2022. So this slide shows US auto demand, and the chart on the left-hand side shows the weakness that we've been seeing in the US auto market in recent years. The chart on the right-hand side shows that market share of large vehicles versus cars. And nearly 80% of market share in the US goes towards these larger trucks and SUVs. And this is particularly supportive of palladium fabrication demand, just because the US market is extremely large, and the fact that there's a demand for these larger vehicles helps to provide support to palladium demand. China's auto sales had a rough start to this year, with COVID-related shutdowns choking off demand. There has been a strong rebound in June following the reopening and the introduction of some fiscal incentives. However, these fiscal incentives are targeted more towards smaller vehicles and towards battery electric vehicles, which is not necessarily positive for palladium fabrication demand, because the smaller the vehicle, all other factors held constant, a smaller vehicle would consume smaller amounts of PGMs. And so this is not necessarily a positive for palladium fabrication demand. The palladium market was in a surplus for the second consecutive year during 2021. And while the market flipped to a surplus in 2020, palladium prices have remained high and risen to record levels during this period. And this is primarily because investors have been willing to absorb the surplus metal. These investors were buying metal on hopes of a revival in demand and on concerns of lost mine supply due to flooding at two of Norilsk's mines last year. Investors have remained interested in palladium during 2022 as well, in part because of palladium's ability to sustain high prices over several years, and in part because of supply side concerns, be it the lost output at the Stillwater mine due to flooding this year, or concerns about supply disruptions from Russia or South Africa due to the war or potential labor strikes. So there's been a lot of supply side support to palladium investment demand this year. However, in the absence of supply-side issues, Palladium's weakening fabrication demand fundamentals could weigh on investor interest and Palladium prices during the second half of the year. After several years of net declines, Palladium ETF holdings rose in 2021. However, these additions were fully reversed during the first half of 2022, and so essentially Palladium held by ETFs is back to levels that were seen at the end of 2020. That we move on to rhodium. Total rhodium supply rose during 2021, but still remained below levels seen in 2019. Total mine supply and scrap supply rose during 2021, lifting total rhodium supply to 967,000 ounces, which was up roughly 5% from 2020 levels. Rhodium scrap supply that has been in a rising trajectory for a few years now rose during 2021 as well, driven higher by record rhodium prices and a buildup of scrap inventory becoming available during the year. Total rhodium supply is forecast to decline in 2022, with both mine supply and scrap supply declining during the year, driven by some of the same factors that are expected to weigh on platinum and palladium supply. Rhodium fabrication demand's heavy reliance on the auto sector made it vulnerable to the auto production problems that the auto industry was faced with last year. And while rhodium fabrication demand rose in certain sectors like the glass manufacturing, glass equipment manufacturing industry, it was still sharply lower than what was seen in 2019. Problems in the auto sector are expected to continue weighing on demand during 2022 as well, potentially pushing rhodium fabrication demand to its lowest levels since 2008. Now, while the rhodium market has moved into a surplus since 2020, the market still remains extremely tight. The rhodium market tightness can be explained by the 8 consecutive years that the market was in a deficit between 2012 and 2019, and that for the most part since the early 1980s, the market has been in a deficit. So the tightness in the market is reflected in the rhodium price, which has risen to incentivize inventory holders to release their stock. The ongoing buildup in inventories over the past 2 years and into 2022 is expected to act as a headwind to rhodium prices, especially in the face of slowing fabrication demand. So with that, I'll pass this back to Jeff to speak about the minor PGMs.
Hopefully you can see my screen, minor PGMs. I won't spend a lot of time on these. Ruthenium prices started rising very sharply at the end of 2020. They got very high in the first half of 2021. They've come down, but they remain very strong. And what we've seen in the ruthenium market is really strength in fabrication demand. There hasn't been a lot of investment demand in ruthenium, but you have seen strong fabrication growth. Some of the industries that use ruthenium have not been negatively affected by supply chain interruptions, and the demand for those products has remained relatively strong. Iridium prices also rose very sharply. They started really, I think, in December of 2020, got to around $6,000 an ounce in early 2021, came back down, lost almost half of that value, but since then has risen back. Similar to ruthenium, what you saw was a big increase in iridium fabrication demand. And in addition to that, both in ruthenium and in iridium, but perhaps especially in iridium, fabricators who use this metal, it's used in crucibles and other equipment to make crystals that are used in LED lights, in LCD panels and other applications. The demand for their products has been very strong, and the need for iridium has been very strong for really more than a decade now. And you've seen inventories of both ruthenium and iridium drawn down to very low levels, thus the strength in the prices. These are metals that were surplus, or they were byproducts of platinum, palladium, and rhodium for many decades, and inventories were built up over those decades. And they've been really drawn down over the last quarter century. They seem to be reaching very low levels. And so the fabricators who use iridium and ruthenium in early 2021, facing very strong demand for their products, were buying more metal, and they for current consumption, but they were also trying to buy some metal for inventory building. In addition to that, in the iridium market, you had some speculative investment demand. And when we talk about investment demand, we're probably including some companies that are trading companies and dealers who may have been building up inventories because they were seeing their own fabricator clients needing this metal and willing to pay higher prices for it, similar to what we saw in rhodium. Osmium prices, sorry about that extra line there. Osmium prices were basically unchanged at $400. It's a relatively esoteric metal. It does have a few uses. We saw some people start to talk about investing in osmium in early 2021, but it had no noticeable impact on the price of osmium. And I think they have kind of backed away from that. CPM Group's own view about investing in these minor PGMs and investing in other non-exchange traded metals is that they probably don't make sense for the vast majority of investors. We have worked with investors who have invested in not osmium, but iridium and ruthenium over the years. We have a policy that we only will work with investors interested in these metals if we manage the positions for them, because it's very easy to buy iridium or ruthenium if you're willing to pay the price, but it's very hard to sell it at a relatively good price. I believe that's all that we have now, so we'll open it up for questions. Carlos Sanchez will parse out the questions to Rohit and me. Carlos, feel free to go ahead. I'm going to leave my screen on, but I'm going to go to this one because I think that this might relate to some of the questions, and I can move it around as we see. So Carlos, you want to start with a question?
Okay, let's start, I guess, one related to iridium, ruthenium. It says, if demand is so strong for these metals, why, when one tries to sell these metals, sometimes one is quoted 20 to 30% less than the published price?
The published price is the price at which you can buy the metal. And it's not unusual in exchange traded metals, including rhodium, to see 100% spread between the buy and the bid and the ask. That's why I made the comment that when we work with investors, and we only work with a few investors who are very sophisticated about this stuff, we want to be involved in the management of it. We've seen markets damaged by not only investors, but also industrial users, in the case of ruthenium, who bought a lot of metal, realized they didn't need that much metal, and when they went to sell it, they drove the price that they could sell it at down. And you had at one point around, this was in ruthenium, and it was right here when the price got up to about $860. If you wanted to buy the ruthenium, if you wanted to sell it, the price that you could receive was $430. It was 100% spread there. The problem is that you're dealing with extremely illiquid markets that have a handful of dealers and fabricators who have experience here. And when they're buying, it goes into their inventories. And they have no idea how many years or decades it may be in their inventories. So they're going to be extremely scrupulous about what they pay for metal that they may be holding for an indefinite period of time on their inventories. And they can do it because it's a very small illiquid market. You see the same sort of thing went on 10 years ago when a lot of investors were told that cobalt was going to be the go-to metal for lithium-ion batteries. And you had a lot of people pour into cobalt. And then when they realized that they were substituting manganese sulfate for cobalt sulfate, people tried to sell that cobalt, and voila, the price that they could receive fell very sharply. Next.
Okay, next question. Can you expand on why some companies forecast a 500,000 ounce deficit while CPM forecasts a 500,000 ounce surplus?
In palladium.
Correct.
Correct. They're talking about palladium. Yeah. I'll handle it first, and then I'll kick it over to Roa if he wants to add. CPM Group is a commodities research company, and we follow Commodities Research 101, which is that your surpluses and deficits are newly refined metal entering the market from mine production and scrap recovery, less fabrication demand. We do not include any surrogates or variables or estimates for investment demand in our surplus deficit. We do that for a variety of reasons. First off, investment demand is radically different from fabrication demand. The factors and reasons that cause investors to buy metal are radically different. Investors don't use that metal and sell it in fabricated products. They can come back as sellers at any given time. So you have those issues. The price elasticity and other issues are different. But more importantly, if you're looking at a market and you want to know, is this market tight or is it well supplied? You want to look at the relationship between newly refined supply and fabrication demand. Fabrication demand comes from fabricators who need that metal for their product. They're not discretionary participants in the market the way investors are. So if you look at commodities research across commodities, Commodities Research 101 is newly refined supply, less fabrication demand, or in the case of agricultural and energy commodities, consumption. Yeah, precious metals and other metals, generally speaking, are not consumed. They are used and they can be recovered. But you look at the market because you want to know if that market's tight on a fundamental basis, excluding investment demand. In the 1990s, various industry promotional organizations worked with some companies to say, let's add investment demand. They started with silver, they went to gold and platinum and palladium. Let's add investment demand because we're in the business of trying to convince investors that these are bullish markets. And if we add investment demand to our supply-demand balance, we can say these markets are in deficits. We don't include fabrication demand in our data because we want to know what the market's fundamental balance is. And some of these guys have now admitted this and say, oh, well, you're talking about the primary surplus or deficit as opposed to the total surplus or deficit. And the answer, I guess, is yes. We're talking about the market. We want to know what the surplus deficit is relative to fabrication demand. because that will give you a much better understanding. It's the first leg of your analysis in determining where the price is going. If you want to promote precious metals, you throw in investment demand and other stuff to show a deficit. Sorry if I'm blunt, but really that's the nature of it. Rohit, do you want to add anything to that?
No, I think that's a pretty whole explanation, and I think it is really just, the addition of investment demand to the statistics that tends to create that deficit.
While we're at it, let me add, let's look at platinum. It's very interesting because look at those big surpluses from 1986 to 1993. And look at the line that shows you the platinum price. And I'm sorry, we didn't have the palladium price on that chart. The platinum price fell during a period of large surpluses. Now, contrast that to these even larger surpluses from 2002 to 2011. And the price of platinum goes from, what, $500 to $1,680 on an annual average basis, over $2,000 on a daily settlement basis. The difference is that in the 1980s, those surpluses were absorbed by South African mining companies. And they were market makers in essence. They were buyers or sellers of last resort, or sellers of first resort, buyers of last resort. If you had platinum and you didn't want it in the 1980s, Rustenburg would buy it from you. And later on in the 90s, we were actually buying Impala platinum for clients of ours from Rustenburg, because not only had they kept their own metal and allowed their fabricating clients to not necessarily buy all of the metal they were contractually obligated to buy, but they would buy Impala and Western platinum and Norilsk platinum, so Russian, back then Soviet platinum, if it was sloshing around the market. They were doing that because as part of the Anglo group, they were following the De Beers school of thought, which is we're buyers and sellers of last resort of our product. We'd rather own the inventories and help stabilize the price. 1993, 1994, South Africa moved to a multiracial democracy, and the company said, okay, we're no longer the buyer of last resort. In that period, 2002 to 2008, those inventories were bought, those surpluses were bought by investors, and the price rose. Investors said, I want to buy platinum. The price has been between, $360 and $550 for 15 years now. The market looks like it's getting tighter. I want to bid up the price. I'm willing to pay a higher price than 500 or 550 for platinum. And those inventories, those surpluses were bought by investors. You won't see that if you throw a dummy variable for investment demand into your supply and demand balance calculations. Sorry if I went on too long. Carlos, you want to try another?
Okay, next question. What is the source of CPM's data for US commercial vehicles? It appears that demand for these vehicles is strong and production is being limited by supply chain issues.
Rohit, you want to take that one?
Yeah, sure. So we use automotive news for commercial vehicle data, and the US market is in relatively better shape than some of the other markets, but it is still showing a decline in demand compared to what it was doing last year. And this is really not too surprising given the expectations of slower economic growth and higher interest rates, which is causing businesses to pull back on making capital investments in commercial vehicles.
Okay, next question. Can you please provide some insight into the physical demand for platinum from China?
Rohit, you want to take that one?
Chinese demand has been fairly healthy. There was a pullback earlier this year because of the problems that you saw with COVID-related shutdowns. The jewelry market is important in China, though you have been seeing a decline in demand for jewelry in the Chinese market over the past several years. But it is still the largest platinum jewelry market in the world. Demand for platinum has also been ticking higher as they've started to introduce platinum into gasoline autocatalysts. So there is a bit of support for demand for platinum from there as well. Commercial vehicle sales have been faltering. So from that particular sector, you've seen some reduction in demand. But on the whole, it's doing okay so far, but we do think that platinum demand would soften going forward in China as well.
Okay, another question is, what is the possibility of stagflation and its impact on PGMs?
I'm not sure that we have a number that we're applying to stagflation. We're not necessarily expecting it. Our expectation is that inflation does come down over the next several years, and that economic activity will be extremely volatile. As I said earlier, we're looking for a modest, possibly a modest recession already now, followed by very anemic growth in 2023. Possible recession, and then relatively strong areas. So we're not, we haven't assigned a probability to stagflation, but we don't think it's necessarily very low. We just, like literally yesterday, finished updating our 10-year projections for economic activity in major countries and regions. And it's very funny because, we lowered our 2022 projections sharply, as have most people. But when we came to 2023, we found that for the advanced economies of Europe, Japan, the UK, and the United States, while a lot of other projections from the IMF, the World Bank, the OECD, and mainstream economists have lowered their 2023 projections for real GDP, our projections for 2023, which were last updated in February, were already much lower than a lot of those guys' revised projections. So we did revise our Russia, obviously going to be lower than we had thought prior to the invasion of the Ukraine, China and India and Brazil projections. But for the advanced economies, we kept them. So we're not necessarily, if we do see a period of stagflation, our expectation is it would be limited to probably the last half of this year in early 2023, and that by 2024, economic volatility would probably be changing. You'd be seeing lower inflation and perhaps somewhat stronger economic activity before we slipped into that next recession. So we don't really have a percentage probability on stagflation. We think the economy is going to be much more volatile than it was, we've said it repeatedly and we'll say it one more time. Well, I say it more than one more time. This is not the 1970s. The world economy, the world financial systems are radically different from where we were back then.
Okay, next question. Are platinum inventories flowing out of NYMEX and into China?
Rohit, do you know, I don't think that platinum inventories have been falling on NYMEX, but to be honest, I haven't really looked at them. Do you know, Rohit?
I haven't seen that specific flow either.
Yeah. No, I think that the platinum inventories that are insofar as platinum is flowing into China, I don't think it's coming out of New York market inventories. It's coming out of other places around the world.
Another question, are flows of Chinese imports captured in CPM's platinum and supply and demand numbers?
Ports or inventories?
Imports.
Rohit, you want to address that one?
Yeah, I mean, they are captured in terms of the net flows and the impact that has on our fabrication demand numbers. In that sense, yes, it is captured.
Yeah. We do have, I'm pretty sure, platinum imports into, maybe we don't. I thought that we had platinum inventories, imports into China in our monthly precious metals advisory. We look at them. We obviously take them into account. Imports per se are not fabrication demand. So, you know, it's one of the factors. It's one of the data points we look at.
Okay, next question. Does the continued surge in electric vehicles share of the market spell a doom for PGMs?
Rohit, you want to take that one, or?
So yeah, we do expect that electric vehicles, depending on how you categorize them, because it's only the battery electric vehicles that we see as being negative to PGM demand. That market share has been growing. And so yes, it will hurt PGM demand going forward. But it's not all electric vehicles, and it's not all alternative auto technologies that are negative for PGM demand. So if you look at hybrids, they actually are as supportive as an internal combustion engine, or sometimes can be even more supportive to PGM demand than an internal combustion engine. Then you have fuel cells, which right now are a very small, minuscule almost sector, but there is potential for demand growth there as well. But if you're looking specifically at battery electric vehicles, that's negative. And yes, we do, take that into consideration when thinking about the fabrication demand numbers.
Okay, next question. For the average investor interested in platinum or palladium, would you recommend an ETF or a coin?
Yeah. The rest of the question, for those of you who may not see it, is we've all heard the mantra, if you can't hold it, you don't own it. And that's, I guess it's a mantra, which is a religious-based paternoster, for want of a better word. It depends on your investment horizon and your rationale for investing. For platinum, if you're a longer term investor, really both of them work. If you're looking for price exposure, ETFs are probably better for you. And there's an ease of purchases and an ease of resale, which is a benefit for ETFs relative to coins. If you want platinum coins, makes sense. I prefer the maple leafs and the eagles, not because those mints are clients of ours, but because they are the most recognized and traded and purchased platinum coins. And so you have a liquidity and a much more global recognition of those coins as otherwise. And, if you're a long-term investor, coins or ETFs make sense. If you're a shorter-term investor and say you, or even an intermediate-term investor, by which we mean, time horizon of 1 to 3 years, ETFs probably make more sense than coins, although they're not as pretty as the platinum coins.
Okay, that was the end of the last question, Jeff.
Okay. Thank you all for being with us. I hope this was enjoyable and entertaining. There were a couple other comments, like, for example, some people have radically different figures than CPM Group on not only surpluses and deficits, but on fabrication demand, and I'm not sure what else. We've been doing this since the 70s. We have a pretty good track record of calling the market prices based on our fundamental analysis, which suggests to us that our fundamental analysis probably is pretty good, because I don't think a coincidence lasts 43 years. Maybe it does. We hope this was useful for you. The Platinum Yearbook is available at our website as an ebook that you may purchase and download. And we will be around with our usual bi-weekly videos and other events over the course of the year. And then next year, we will restart our yearbook cycle once again, because we have produced gold, silver, and Platinum Group Metal Yearbooks since the early 1980s. Enjoy yourself and take care of yourself and those around you and the greater world at large. It needs all of our help. And we'll be talking to you soon. If you have questions or want more information than is readily available on our website, info@cpmgroup.com is a general email address that you can address questions and comments to us at info@cpmgroup.com. Thank you and have a good rest of the day.